Hello. Today in our episode, we want to talk about what do we need to learn to be successful in investing and specifically in real estate investing, and who better could we invite than Whitney Elkins Hutten, who is actually the director of investor education in her company, and she will tell us on about what are the things that you really want to pay attention to and how can you gradually increase your knowledge so that your confidence with your investment keeps increasing and you can ultimately build a portfolio that actually helps you to reach your goals. So stay tuned for this amazing episode. Hello, everybody, to another episode of the Ideal Investor Show. We have a very special guest today. Whitney Elkins Hutten is with us from, what's it called again? Passive Investing with Whitney.com. So we're going to get to that again at the end. But Whitney, welcome to the show.
Thank you. Thank you so much for having me. This is a pleasure.
Yeah, same here. I really appreciate that you made the time. And you have actually a title when I looked at your website where I have to say, I wish people, not only with the title, but with the role, if I'm interpreting it correctly, would exist on every level of education. So for our audience, Whitney's title is Director of Education. So tell us a little bit what you do as a Director of Education.
Yeah, definitely. So I'm the Director of Investor Education here at passiveinvesting.com, and we are a private equity firm that focuses on building passive income streams for our investors, but through investing in assets that are backed by hard assets, primarily real estate, and also assets that have the potential for long-term wealth build. And, our main geographic focus area are the Carolinas, South Carolina, North Carolina, Texas, Florida. We've recently gone into Georgia as well as Tennessee. And, we do multifamily equity projects, car washes, self-storage, and hotel projects. And then we also have a real estate debt fund. So we run that gambit of providing, helping our investors not only build their portfolio, but diversify across several different areas that are uncorrelated areas of real estate.
Yeah, that's really cool. And thanks for speaking about that. And just for the audience, I looked it up real quick when Whitney said we gotten a little bit into Georgia. The little bit is a 340 unit new construction real estate development. So I wouldn't call that a little bit, at least on my scale. It's pretty sizable, So that's really cool. One thing, and I said that there are a couple of things that I really love about how you describe things and how you I'm assuming, think about it. And that has to do, like, when one of the questions, when we fill out that little questionnaire getting ready for the podcast, asked, what do we want to talk about? And you said creating time freedom by shifting the investment model from active to passive, which is what I'm blabbering about all the time. So tell us a little bit how you guys actually think about it and how you go about it.
Yeah, definitely. Well, part of that is going back to my personal journey. So where I am now, I have a portfolio of over 6,300 multifamily and residential units, 1,400 self-storage units. This is just my personal portfolio outside of passiveinvesting.com. A majority of that is passive investments, but that's not where I started. I started off in 2002. And honestly, totally by accident. I bought a house with a significant other, and the relationship, fell apart. About a month later, here I had a house. I thought it was going to sink me, and I stuffed it full of roommates, completed the rehab on the project, and then I'm like, I got to get rid of this thing. It is the worst. It's not an investment. It's the worst thing. It's going to sink me. And when I did sell the project about 11 months later, I walked away with $52,000. And then on top of that, I had been making money every single month, hadn't paid for any of the mortgage, any of the bills. And I'm like, whoa, this is amazing. This is what they, talk about when they talk about investing in real estate. Mm-hmm. And so I did several more live and flip projects like that. That term did not exist in 2002. YouTube didn't exist. I had to do all of this rehab myself, looking things up in a book. Yeah. And when it goofed up, I was like, I had to go get the plumber to come in and fix my work.
Yeah, I mean, Brandon Turner is always claiming from Bigger Pockets that he coined the term house hacking. I'm not sure if that's really true, but I mean, live and flip house hacking. Yeah, that's really cool. Yeah, keep going.
Yeah, definitely. Well, my curiosity was piqued. And, because I had made more money in 11 months or just as much money in 11 months as I had made at my day job. That was, taking me 80 hours a week and a lot of travel for me to bring in that type of income. I'm like, whoa, I just doubled my income in 11 months. This is amazing. So I continued to do those projects on the side. And then, my husband and I got together. We did a few more projects together. And we just couldn't quite figure out how people were. We didn't have anybody in our circle that was doing this. We couldn't figure out how people were, unlocking their golden handcuffs. We were like, we just have another job doing these live and flip projects. And then somebody one day said, why don't you keep some of your properties? We were like, oh, put a renter in it. That's amazing. And if anybody knows me, once an idea clicks, I'm like down the rabbit hole. So we scaled over 30 rentals within about 1.5, 2 years. And we were still flipping on the side. So we were executing what we call the BRRRR strategy: buy, rehab the property, rent it out, refinance, and then repeat it. So we were continuing to pull all of our capital, or majority of our capital, out of all these projects. Built this portfolio, and we hit a level of achievement. I was like, well, on one hand, I wanted to be able to stay home with my daughter because, we go back to creating that time freedom, right? And I was also taking care of family members at the time. And then on the flip side, I'm like, we need to continue to scale and build because now my husband wants to be at home too. And I'm like, ooh, we got to go bigger. We got to go with like larger projects. That led us into that next transition. Like, do we have to do it all actively, or can we invest in other people's projects and lever a team to help us get there? And there's a really important book, that I read at that time. Most people read Rich Dad, Poor Dad, but I read the second book too, Cash Flow Quadrant. And the Cash Flow Quadrant is in the first book, but, I had to be smacked over the head a few times. And I read that second book and I was like, oh, I'm self-employed with all these single family rentals that I'm doing. And even I had a 52 unit. I was leveraging property management, right? But I was still just a self-employed person. I hadn't even figured out how to scale a business, bring people underneath me to help me manage what I was building. I'm like, but I can go right to the I quadrant, to the investor quadrant, if I invest passively in other people's projects. And that way I could my time and attention can stay focused on what it is I am trying to build myself, but I can still leverage the power of real estate. Because we wanted to diversify ourselves into self-storage, into mobile home parks, residential assisted living. And I'm like, I can't become an expert in all those different categories. I shouldn't become an expert. And that's really where, we started building both the active and the passive at the same time. And, fast forward a few years later, when we sat down to really figure it out, our return on our time, that's when we were like, man, passive. On paper, you can make more on the active side. But when you're talking about the return on your time, there's just no investment that can beat the passive investing in real estate.
Yeah, I totally agree with that. And for our audience, when you compare the scale that you guys are operating at, Whitney, with the scale that we do basically on this individual level, vast majority for non-accredited investors is basically taking a little bit of a twist of what you're doing. And I'm really curious how you would actually contrast and compare that, because just to remind the audience, what we basically do on one-on-one working with individual families is to say, okay, because we don't want to do like the BRRRR strategy, because most of the time people have a job and a family and all these kind of things. So they don't really want to make real estate their job or the predominant thing that they spend their time on. But they at the same time also want to, or at least until recently, last 6 months is maybe a little different, but up until then, also take advantage of the benefits of leverage and depreciation and those kind of things more directly. And so we developed basically this out-of-state turnkey model where you're basically working with property management, with the renovation team, with the construction team and so forth, but not in the sense of overseeing which window goes into which hole, but basically developing these relationships with the organizations who make that their business without going all the way to syndication. Like I would kind of interpret what you guys are doing, because we then still retain the ability to say I do an 80-20 deal where I put 20% down and 80% I get from the bank. So from a director of education or investing education, the differences in, if we stay with like, for example, your Georgia project, where would you say is the space for people using our turnkey approach in a passive sense? Because as soon as you've done the deal, you have property management in place, you have your financing in place. All you basically do is you get the owner distribution from the PM every month. And then we do a little bit of a twist on cash flow parking in a tokenized real estate platform. but that's about it. You don't really do much on a monthly basis. And if there ever is anything to be done, then the maintenance of the PM is doing that. So if you contrast that with what you typically do, how would you point, or what are the differences to, like, if somebody were to say, yeah, I want to get with Whitney in her 340 unit Georgia project?
Yeah, so there's a little bit to unpack there because it's really not a question of either or, right? It can be a question of and.
Right, exactly.
And I encourage people to really kind of take a step back and understand what their goals are with their real estate. And so, number one, I would assume everybody like listening here has some sort of buy-in that real estate,
Hopefully.
is it going to be impactful for their journey, right?
Now,
I mean, that is the first question to answer for yourself. If you don't believe in real estate, don't invest in it, okay? But if we've overcome that hurdle, then the second question then is, what do you need from your real estate? Do you need cash flow, appreciation, diversification, tax benefits? Do you want to be active with your time? Do you want to be passive with your time? Okay. Do you want some sort of split, right? Like I have a split portfolio. I still have active investments. And the reason is because I want to have control over those investments. I want to have control over when I buy, how I buy it, who is in the property, when do I refi it, when do I sell it, right? So that is kind of the case in question with an active portfolio. Now, at some point in time, if I'm building everything actively, and guys, I get it, right? Like it's still considered passive real estate, passive income by the IRS, but it doesn't mean that your time's passive. At some point in time, there's going to be a scale. I'm going to hit a ceiling and I'm going to have a choice. Do I want to build a team underneath me to help me kind of offload some of that pressure? Or do I want to build out also a passive side of the portfolio? And that's what we can help somebody do. Now, for high income earners, or people that have a higher and better use of their time in their job, maybe a doctor, a lawyer, a tech person, and they can leverage the cash flow that they're bringing in and can actively through their job or through their business and then channel that into passive real estate. Now they're not even like diverting their time and attention trying to buy smaller properties. Now what you're saying is turnkey. That's fantastic, right? Because that's kind of the happy middle of the two. And if you think about what we're doing with syndication investments, these larger projects, it's essentially multifamily turnkey, multifamily, self-storage turnkey. We're just talking about accessing higher quality projects, and then not even higher quality projects, but larger projects, probably, maybe a breadth of, scalability in there. You can get access to multiple markets. And then, also take advantage of an expert team actually running the day-to-day operations. And, with typical turnkey, and, your model can be quite different here, is because there's this hybrid space that's evolving, is with the typical turnkey, somebody is doing all the rehab for you on, say, a single family or a small multifamily. They're putting a tenant in place, they're placing property management, they're handling all the heavy lift parts. The buyer just has to secure the loan. The investor just has to secure the loan, and then they hand it over to property management. But it's putting the investor in a COO position because they still have to manage property management.
That's definitely true, although it's for the most part pretty passive. I mean, it's maybe not quite as passive as syndication, but it's probably as close to passive as you can get without, especially, and this is one of the things, and I'm sure you would say this even for a GP in a syndication, ultimately it's really a matter of the quality of the team that you're working with, right? If you really have a caring, professional, really well-working property management organization within the frame of the turnkey provider, and that's one of the things that I always point out. One of the distinctions is the turnkey organization as a company, does it consist of a marketing and sales team, a renovation team, and a property management team where they work together and basically build the projects and take care of the projects together? Or is each individually separate from each other? Well, then you're sitting in the middle of the triangle. And as you probably point out, then you are basically the COO of managing these three entities, whereas what we're trying to do, at least with the relationships that we make available to our clients, is to almost exclusively work with, like, for example, the REI nations of the world or stuff, where that is all under one roof. And not only is it kind of like helping each other, right? Like if you renovate it well, knowing that you're going to have to manage it later, then obviously you pay a little more attention. I don't want to say flippers generally do a bad job. That would be wrong and not really true. But there is psychologically a difference if you renovate a property and you sell it and you never see it again versus, my friend Johnny in property management has to take care of it. And so we want to make sure that this works, especially from a warranty perspective and stuff. So this under one
Well, and
roof thing is
relationship.
probably like, yeah, it's kind of like, if you say, okay, here is Burr or here is flipping or wholesaling, is kind of like one level. Then I would say this all-inclusive turnkey is the next level. And then what you guys do from a GP perspective or general partner offering these projects to limited partners is on scale and size and all of that, the next level. Can you say a little bit about what does it actually take from like an educational perspective for an investor, a regular person who may say, okay, well, I have a couple of singles, I have maybe a duplex and a triplex, and now I'm thinking about participating in something bigger, regardless whether it's necessarily for being more passive or less passive. But what does it take, and how does somebody actually kind of wrap their mind around the setup that you guys do?
Yeah, definitely. Well, we touched on the goals, and that's number one, really taking account how do they want to spend their time. And then also the business risk, right? What is their risk tolerance? Because there's so many different, types of business plans in syndicated real estate. And what we focus on are kind of, especially on the multifamily front, your stabilized Class A properties that are still very affordable. They're still in, the growth markets, metropolitan service areas, or maintenance on the property. So right now, you're essentially buying it, maybe adding a light value add plan, to increase the rents, add a couple additional streams of income, but no like rehab on the property. We are de-risking our investments by removing the, especially at scale, when you're talking about 340 unit building, the labor costs as well as the supply costs. Those things are bouncing around all over the place right now. Anyways, so, I also encourage the investor to think in terms of that, right? So their goals, what is their risk tolerance? Yep. What kind of investment do they want to be in? And now we can kind of get into like finding an operator, because when you make that transition from controlled real estate, you hold it and, personally titled, or a turnkey type situation where you're still personally titled, but somebody else has done all the large heavy lifting for you.
Right.
And into passive real estate, again, you're now taking off that COO hat and handing it over to the general partner. So what can you control in a passive deal? You can control what your goals are, the type of business plan that you want to invest in. You can control who you invest with, what type of operator. Right. So kind of what you said, it has to be an expert team because you're betting on the jockey, not the horse. And a lot of people that come into the space, they're like, they're used to finding their own deals. They're enamored by the numbers. And they forget that they're actually investing in a business, not the deal directly, right? So the operator quite clearly top. Then we have to understand the market, and then we get into the deal. So we're essentially flipping the investing model. But for, people who have limited time and attention, and, we all have our different seasons of life. When my daughter was little, I was changing diapers and stuff like that, but I still had time to like do a lot of research. She slept like 14 hours a night. Like I got my nights and I was able to really invest in real estate. Now she stays up to 9:30 at night. She wants to play games. She wants to talk. And so I actually have less time now. So we all have our different seasons of life. Even if you get into real estate, it's kind of like I give people permission to, as your portfolio grows, as it scales, as your different seasons of your own life change, think about complementing your portfolio to add in, a different strategy or two if it's warranted.
Yeah, exactly. And that's part of the reason why we're so glad that you came on the show, because we want to obviously for the audience, not just to say, okay, keep listening to Axel and what he keeps preaching of what we directly help people to go into this first phase. And then also, like, you just said, there is more phases coming after that. So if we look a little bit into the market environment, I think this is really kind of an apropos and interesting question in general, but maybe also for the kind of investments that you guys are offering. I mean, yesterday I saw for the first time, and I didn't really think I would see it this quickly, that like the regular 30-year mortgage is now above 6% for owner occupied. I've seen that our investor loans for, any of the deals that people are currently contemplating, like having a 7 in the front, which I had thought we wouldn't see again in my investing lifetime. So when you translate that to your kinds of deals, I mean, I know that the numbers are significantly bigger, but I'm pretty sure you're not totally immune to what happens in the financial markets. How would that translate into any of those deals that people sign up for?
So, we aren't currently on our projects. We aren't actually, looking for loans from the government sponsored entities like Fannie Mae, Freddie Mac. So we're looking for more private loans. Now, those rates will change, right? People are pricing that into the market. A lot of that pricing, I follow economists. I'm not an economist myself, but, a lot of that particular pricing, according to economists, came into the market March, April, and May. And so really what we're seeing from the Fed is perhaps a delay in them actually reacting. Now, that said, if you're looking at a conventional 30-year fixed mortgage, that's going to react, very differently, to the market as well. There's, because they have to package everything up and they sell it off as a mortgage-backed security. So those type of rates are going to continue to probably bounce around, but a lot of these more private type loans, a lot of that pricing is already kind of baked in. And so what we are seeing currently on the multifamily front, we're still able to get private lending and, in the 4.5 space on, self-storage, 4.5 to 5. On our hotel deals, 6%, and on our car wash deals, about a 5.5. So we're still very well arbitraged with the inflation environment.
So do you see, this is only my experience by keeping an eye on what happens in the markets, that it used to be that private lending of any kind had typically a little bit of a spread between what could a private lender get with a very secure to medium secure kind of approach, through like government paper and stuff like that, versus putting it into something I don't want to say it's more risky. It's just, either longer term or more volatile or stuff like that. So it sounded a little bit the way you're describing it. Yeah, the government is giving you 4%, but you still put it in real estate, when it used to be when the government gives you 1 or 2% and you put it in real estate for 5%. Okay, then yes, it may not be exactly the same, but you're actually making a little more. So do you see that is going to change? And I'm not so much interested personally, I think, in the audience in the details of the calculation, but what happens to a deal where you say, okay, well, we have a minimum investment per unit at 50,000, for example, to participate, I don't know, in our Georgia deal or something like that. And the financial environment, and this is something that we're facing in our world with our turnkey investing, is we're always looking at the performance of the deal, the performance ultimately of the asset, right? And so if things like the lending, whether it's private lending or FHA lending or no-doc loan lending, we do all these different kinds. But obviously, if we go from, let's say, 4.5 to 6.5 or 7, the performance aspect of the deal can suffer. And I wonder if there is anything like that, or if it's just, okay, don't worry about it. It's all locked in. And if you sign up as an LP, then you're good to go. And I really honestly don't know. So I'm asking you.
Yeah, no. So there's, again, several factors to unpack there. So like I said, with our interest rates on our projects, we're still like in that 4 to 6%. Now, obviously the interest rate is going to affect the debt service on the property. Hands down. It's like, owning a single family property or small multifamily. Now, the biggest difference that I can draw here, because it's impacted in my portfolio as well, is when we're dealing with single family property and small multifamily property, maybe they're like the 1 to 4 units. And I argue up to 50 units because
right.
I'll tell you why here in a second, but especially that 1 to 4 space, your valuation is based on comparable sales. So whenever you go to sell that project, it's based on what the guy sold his for in the last 6 months.
Right.
Okay. So that's why we have to get an appraisal. Now, when we do an appraisal on a larger project, technically 5 units or over. However, I argue it's 50 units because this 5 to 50 units is kind of a no man's land. And I'll explain that in a second. But 50 units or more, now we're getting in based on net operating income. So I actually have multiple levers I can pull in the project to better control the valuation and the performance on the project. How can I take the project and get it to market rents? Do I need to burn off concessions with the previous owner? Do I need to do a light rehab on the property, maybe paint carpet, flooring, whatever, to make it all nice and pretty? Do I need to do exterior maintenance in order to get, command market rents? How can I decrease the expenses on the property? Can I renegotiate contracts? Can I change property management? how can I add additional streams of income? Now, the first two, increase income and decrease expenses, you can do that on your smaller real estate, 1 to 4, 1 to 50 units. It's adding additional streams of income, especially on those 1 to 4 units, that is very hard. I've tried to rent, and I'm like, yay, I've got a shed in the backyard. I'm going to try to rent that for extra. And the tenant says, no, I don't want it. And then guess what they do? They break into the shed and they use it. Oh, all of a sudden the lock's gone. But I can do that on a larger property, like a 100-unit property. I can increase the amenities on the property and charge an amenity fee. I can do pet leases at scale. I can maybe bring in a utility to the project, move all the cable and the fiber internet to the property. I can do these type of things to add that top line dollar to the profit and loss statement. And when I do that, I get rewarded based on valuation. So when we say, is the rate going up and the expenses going up on the property? Yes, it does impact the bottom line. However, I get to now be more creative in my plans in order to add value to the property because I'm going to be rewarded for it. And that kind of counterbalances itself. Whereas on single family real estate, there's very little I can do past making sure that my tenant is paying the top rent in the area. I can't really move property management too much and create operational efficiency there. I can't add additional streams of income. And I'm locked in on my valuation being comparable sale. So that's really where the biggest, starkest difference between the smaller units and the larger units really lies. Now, I've alluded to that 1 to 50 space. The 1 unit to 50 unit space is kind of a no man's land. And it's because even though the 5 to 50 unit should be technically valued as commercial real estate based on net operating income, but there's a lot of people in the world these days that they don't care about that valuation. And those are smaller transactions, and they're willing to potentially overpay. They've got millions of dollars coming out of a 1031 exchange. And so they'll just pay cash. They have foresight that, in 3, 4, 5 years, it may not be cash flowing what they want it now, but in 4 or 5 years, well, they've got the cash, they just buy it. And so technically, yes, it's evaluated based on net operating income, but you've got a lot of people that have just the liquid reserves to be able to buy cash.
Yeah, absolutely. And
so one thing that I would say, larger space.
Yeah, and one thing I would say, and I think you might be able in a larger scale to even benefit a little more, you pointed to, improving basically the quality of what is being offered to the tenant, which smaller scale or larger scale, I think applies generally in both areas. But one thing that I personally see from a little bit more macroeconomic view is there have been probably a bunch of people, especially when the economy started coming up again and, getting out of pandemic and stuff like that, people getting into jobs, we have relatively low unemployment rate, that actually thought about, hey, maybe it's time to look for my own place. Not expecting that in 4 or 5 months, the interest rate environment explodes from below 3% to 6% or more for their owner-occupied situation, which to me, if you ask my opinion about it, yes, on our smaller scale, it might benefit us a little bit. But if you have a 300-unit relatively new or brand new place, all these people who were hoping or looking to potentially go on their own property will either no longer qualify or will say, I just saw the statistic yesterday, just to give a little flavor, right? The median price for single family residence in the United States is around 400,000 right now. If you compare November 2021 to today, the increase in cost per month that you have to pay is $800 plus or minus. So if you ask yourself, okay, do people really have $800 more per month? Or in reality, since you can't really borrow more than 50%, you would have to have $1,600 more per month available to even look at the same deal. I think a lot of the deals or a lot of the things that people were looking at, seriously considering, and even people who were already under contract, the bank might say, sorry, but I can't give you the money anymore because it just would require such a high payment that you can't afford it. Well, all those people would say, well, where's a really nice place where I can live? And they say, hey, Whitney, do you have anything? Right? So, and you can say, well, I have 320 because the other 20 are already gone. So, which on a smaller scale, we can, right? So this is just to give it a little bit of an economic flavor besides all the things that you listed. So I think we hopefully gave the audience a little bit of an idea of how the larger scale can actually benefit if you want to get into that, maybe as a step up from first establishing those properties and those assets that you have a little more direct control over.
Yeah, I mean, what you just described is going to benefit any investor, rental investor. So it's a matter of like, how can you as an investor get into real estate right now? Or, continue to build your real estate? Because, again, the hike in interest rates, it will impact, the GPs or individual investors being able to acquire a property. It will probably slow that down, but it's really going to hurt, like you said, the retail purchaser. And they're going to have to go rent.
Yeah. Well, and I mean, and all of the people that, we're working with, I can say this for myself as well. If you had any kind of assets that you bought, like, let's say, since 2017, 18, 19, you have so much appreciation sitting in there where you can keep your 30-year loan and get like a home equity line of credit, bundle it 2 or 3 together, and you can buy properties, in the current market, maybe new builds versus renovated or stuff. There's a lot of opportunity there if you're not dependent on, the traditional basic qualification criteria that apply for owner occupied. So yeah, I think that there's a lot, and that's why I love to have you on the show, because there is a lot of education that we need to do, because as these things start moving, more moving pieces are being touched. I mean, for 3 or 4 or 5 years, interest rates were not really a consideration, right? They were pretty stable. Yes, you had to know a little bit about them, but if you did it today or in 6 months from now, it didn't make a difference. Now, if you didn't sign your deal in November last year and you signed it now, wow, suddenly interest rates doubled. It's kind of crazy if you really think about it. All right. Mm-hmm. Cool. So as you know, Whitney, we always ask 2 questions at the very end of our podcast. So the first one is, if you could meet anybody, who would you love to meet and why?
I was prepared for the time travel one.
yeah, that's the other one. That's the next one.
Okay. If I could meet anybody, I'm really excited about this. This is I have so many people in my life that I would really love to meet, Gary Keller being one of them. I'm a huge fan of The One Thing. My daughter and I are huge fans of Jocko Willink, and actually we get to meet him next month, or actually cool. At the end of the month. So I'm super excited.
Yeah.
So that dream is going to become a reality.
Yeah. Can you tell the audience real quick who that is if they are not familiar?
Yeah, so he wrote the book. He's one of the authors of Extreme Ownership, and he also wrote a kids series called Way of the Warrior Kid. And so it's about, how can you take personal responsibility for things? And I really wouldn't do it justice describing it, but it's been a fantastic series, not only for me, like in, my own personal development journey, but, having my child who's under the age of 10 read it, just to understand that, some of the things I'm asking her to do, like make her bed, like there's a larger purpose to this, and her being able to learn how to do executive ordering and just really setting the habits and routines right now that are going to serve her as an adult.
Yeah, that's very cool. And thank you for that, because that hopefully waters the mouth of the audience to kind of check it out and take a look at it. So now, as you have been anxiously waiting, you have our time machine that can go any direction you want. So where would you take it and why?
Yeah, I had. So we were joking, guys. We were joking before the show because I had been asked recently, like, if I could take a time machine anywhere and it couldn't return, where would you go? And I'm like, I wouldn't go anywhere because if it can't come back, I love my life as it is now. So I was really hesitant to answer this question.
For we have the advanced version that you can go and come back.
And guys, this, most people would probably be like, I would take myself, do the Back to the Future thing, right? Get a comic book or like a newspaper and take their previous version themselves. For me, it's kind of hysterical. I would go to a Prince concert, 8 years ago.
Purple Rain.
That is somebody, it's an artist that I love, and I am just, I'm heartbroken that I didn't get to see him whenever he was alive.
Yeah, that would be great. Yeah, that's
not earth-shattering.
And would you be like front row or backstage, or where would you be?
Had I gone before, I probably would have gotten the nosebleed seats. Now that I know what I know, I would be front row.
Oh, okay.
For sure.
Awesome. Okay, well, that's definitely a cool one. Thank you, Whitney, and thank you for being such a great guest on our show. I think we helped people understand a little bit, from single to a little bit of a portfolio to the scale that you guys are working at, and that there's room for everybody to live in this space and be successful. So thank you for making the time and helping educate our audience a little bit. Now, If
You're
somebody
very
said,
welcome.
hey, 340 units in Georgia, that's so interesting. How do I learn more about it? What do they do then?
Definitely. You can reach out to us. You can visit our website at passiveinvesting.com. If you want to talk to me directly, go to passiveinvestingwithwhitney.com. And there I've got some free downloads and goodies for the audience, as well as you can get direct access to my scheduling link, and we can book time together. And I just get a chance for me to get to know you, as well as understand your investing goals and if we're a good fit. So that's passiveinvestingwithwhitney.com.
Okay, that's really awesome. And we're going to put that in the show notes and in the video recording notes and so forth. So again, thank you, Whitney, for being on the show. And maybe we can do it again and see how all these things developed over time.
Absolutely. My pleasure. Thank you so much for having me.
All right, cool. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.